Hi, this is Roger Conrad, and welcome to Investing Daily. What I want to talk about briefly to you today is the rally in the market. I think things are going to continue to be on the upside for the rest of the year. The fourth quarter tends to be a pretty good period. And for the broad market, but also I think for income type stocks. And definitely we've seen a shift over, I think, in the last 2 or 3 weeks from an investment mentality in the public that only bonds are secure enough and worthy investments when it comes to producing income, and stocks were generally to be eschewed because of risks about the economy and so on. I think again this is shifting a little bit. We've started to see some strong buying, particularly in some of the various income investing groups that we cover, MLPs, Canadian Trust, even utilities, which have lagged, seem to be coming along. Just want to caution everybody here that you want to remain disciplined. The best time to buy anything is after people are dumping it and things are selling off and people are fearful. And we've seen this happen many times over the past couple of years. Over the summer, several times. We even see it in miniature from day to day, depending on what the economic news is. What we've seen the last few weeks seems to be one of these periods where investors get a little bit more excited and they get a little bit more willing to take on risk. But this can change on a dime. So what you want to do is really avoid these emotional cycles of the market. You want to buy good companies when they trade at good prices. We have buy targets for everything we recommend in our publications. And that's really the way to go. The higher price you pay for an income investment, even if the yield looks good, the higher price you pay, the less that yield's going to be. And a lot of the things that still have pretty solid yields out there right now are pretty much a minefield. There's a lot of risk out there still. Certainly the economy not running on all cylinders is a big risk. And you really want to avoid 90% of anything yielding over 10%. I think we have some good opportunities. We actually have a new product called Big Yield Hunting, and I urge you to check that out. It's a monthly publication, $6 a month. So you can get an idea of where our thinking is by taking a look at that. And so again, there are some opportunities that focus on higher yielding stuff. But for the most part, I think you're just going to want to be disciplined. And again, remember, 90% of anything yielding over 10% very likely is heading for a dividend cut. And you don't want to be there when the dividend is cut in most circumstances, particularly if it has anything to do with the weakness of an underlying business, because that additional couple of points of yield you reach for can disappear very quickly in an avalanche of a 20 or 30% loss in your capital. Something to consider in a market where emotional swings seem to occur almost daily. Thanks for tuning in. I look forward to chatting with you next time.